So are bonds a good investment when interest rates are falling? You'd think that'd be a simple question, right? But the answer is actually packed with some pretty surprising twists and turns. It creates these massive opportunities, but also some really serious hidden dangers. So how do you navigate all that? Well, let's dive in and figure it out.
Okay, let's set the scene. Picture this. It's August 2011. The economy is still shaky, and the Federal Reserve makes a big announcement. They're going to pin interest rates to the floor. We're talking rock bottom for at least the next 2 years. Now, if you're a borrower, that's fantastic news. But for savers, the Wall Street Journal put it pretty bluntly. They called it depressing news.
And this created a huge problem for just about everyone trying to save money, a problem we're going to call the saver's dilemma. Let's break down what that really means.
So here's the dilemma in plain numbers. At the time, your typical savings account, or a CD, you were lucky if you got a yield of, 0.42%? Barely anything. But at the same time, inflation, the rising cost of everything, gas, food, that was humming along at 3.6%. So here's the crucial takeaway. Any money you had just sitting in the bank wasn't just sitting there. It was actually losing its value, its purchasing power, every single day. This forces a really tough question, right? If just holding onto your cash is a guaranteed losing game, where are you supposed to put your money? For a lot of people, the next logical stop, the seemingly safe choice, is the bond market. But is that actually the right move? To figure that out, we're going to need a plan.
So here's our roadmap for this explainer. First, we're going to decode what a bond actually is. Then, we'll pull back the curtain on the central bank's master plan for interest rates. After that, we're going to get into the really cool part, the surprising bond seesaw effect. Then, we'll go hunting for the risks that are hiding in plain sight. And finally, we'll bring it all together to understand the investor's choice.
All right, first things first. Before we can even begin to talk about whether bonds are a good or a bad investment, we need to be crystal clear on what in the world they actually are. At its heart, a bond is incredibly simple. It's just a loan. It's an IOU. When you buy a bond, you are essentially the bank, and you're lending your money to some big organization that needs it.
And in exchange for that loan, the issuer makes you a promise. It's a promise to pay you a steady stream of interest payments over a set period of time, and then, at the very end, to give you your original money back. It's this promise of predictable, steady income that makes bonds so attractive to so many people.
So who are these groups you're lending money to? Well, it could be a giant corporation, say a company that wants to build a new factory but doesn't want to wait to earn the cash to do it. It could be your local city or town, your municipality, that needs to raise money to build a new school or fix a bridge. Or, and this is the big one, it could be a federal government financing literally everything from roads and bridges to massive national efforts like wars. And this tool can be incredibly powerful. Think about this. During World War II, the U.S. government paid for a huge chunk of the war effort by selling war bonds. They even had Captain America on posters telling citizens it was their patriotic duty to lend their money for the cause. It's a perfect real-world example of using bonds to fund something truly monumental.
Okay, so we've got a handle on what a bond is. Now, let's introduce the main character in our story, the central bank and its master plan for the entire economy. And this brings us to a really fundamental conflict. If low interest rates are so painful for savers, like we saw right at the beginning, why on earth would a government or a central bank deliberately force them down? It just seems to go against common sense. Well, here's the theory, the way it's supposed to work. Step 1. The economy is weak. It's slowing down. Step 2. To get things moving again, the central bank cuts interest rates. You can think of this as putting the cost of money on sale. Step 3. Because it's now cheap to borrow, businesses take out loans to expand, people take out loans for cars and houses. And step 4, all this new borrowing and spending is supposed to act like a shot of adrenaline for the economy, hopefully jump-starting growth.
So that's the textbook plan. But in a really deep crisis, think of Japan after its market crashed, or the US back in 2008. What happens when that medicine, just lowering rates, doesn't work? What do you do when the first tool in the toolbox fails? Well, that is when central banks turn to a much more dramatic, much more controversial tool. A good way to think about it is like a defibrillator for the economy. Lowering rates is like giving the patient some medicine. But when that doesn't work and the patient is flatlining, you have to bring out the paddles to shock the system back to life. It really is an act of desperation.
And that defibrillator, it has a name. Quantitative easing, or just QE. It sounds super complicated, but in simple terms, the central bank basically creates new money out of thin air and then uses that new money to buy up massive amounts of government bonds right off the open market. The whole goal is to flood the financial system with cash, force interest rates even lower, and hopefully, finally, shock the economy back to life.
So, let's recap. The central banks have done their thing. They've forced interest rates down to historic lows. So how does this affect a bond that you might have bought before all this happened? This is where our whole investigation takes a really fascinating and potentially very profitable turn.
Let's run through a super simple scenario. Let's say last year you were a savvy investor. You bought a $1,000 bond that pays a 5% interest rate. That means every single year you get a check for $50. But now this year, after the Fed put its master plan into action, any new $1,000 bond being sold only pays 3%, which is just $30 a year. Okay, now imagine an investor walks up to you. They have cash, and they want to buy a bond today. They can go buy a brand new one that pays them $30 a year, or they could buy your bond that pays $50 a year. Which one do you think they're going to want more? I mean, which one is more valuable to them? The answer is obvious, right? They're going to want yours. Your bond, with its much higher stream of income, is now the more desirable asset on the block. And because of simple supply and demand, the price that someone is willing to pay you for that old bond on the open market has just gone up.
And this right here reveals the single most important concept in all of bond investing. It's the core of this entire explainer, the inverse relationship between interest rates and bond prices.
The best way to picture this is to think of a seesaw. It's a perfect analogy. When one side, in this case interest rates, goes down, the other side, the price of all those existing bonds, must go up. They always move in opposite directions. And that is the potential upside. That's the reason why falling interest rates can make bond investors a whole lot of money. Now that potential for your bonds to go up in price, that's pretty exciting. But a really smart investor never just looks at the upside. They know that solving one mystery often uncovers a few others. So it's time to start looking for the dangers that are lurking just beneath the surface. Okay, so the first and most obvious risk is that the seesaw you were just writing up can swing right back down. If the economy recovers and the central bank starts to raise interest rates again, well, suddenly those new bonds start offering higher payments. That makes your older, lower interest bond look a lot less attractive, and its price on the market will fall. Next up, we have what's called credit risk, or you might hear it called default risk. Remember how we said a bond is a promise? Well, what if the entity that made that promise can't actually keep it? If you lend money to a company and it goes bankrupt, or even a government that can't pay its bills, your bond, your IOU, could become completely worthless. A promise is only as good as the one who makes it. And third, there's inflation risk, which brings us right back full circle to our original dilemma. Your bond might be paying you a fixed 3%, which sounds nice and safe. But if the cost of living is rising by 4% a year, your quote-unquote safe investment is actually making you poorer in real terms. You are losing purchasing power. And finally, we have the big one, systemic risk. This isn't about just one company failing. This is the risk that the entire financial system itself is fragile. When you see a country with a massive debt-to-GDP ratio, huge trade deficits, and it's printing tons of currency, all of that creates instability that can ripple through everything, causing a crisis that doesn't just affect one bond, but the entire market. Okay, we have seen the upside of that bond seesaw, and we have looked at the very real risks. Now, let's put it all together and finally answer our central question. So, falling rates create this fundamental trade-off. It's like a two-sided coin. On one hand, you have the good news. It's great for price appreciation. Any of those older, higher interest bonds you already own are now worth more, and you can sell them for a nice profit. But on the other hand, you have the bad news. It's terrible for income. Any new money you want to invest, or money you get back when an old bond matures, now has to be put to work at these new, painfully low rates. You're going to earn less income.
So let's ask it one last time. Are bonds a good investment in this environment? Well, the real answer is, it completely depends on what your goal is. If you're investing for price appreciation, what some people call capital gains, then yeah, it can be a fantastic time. You can play that seesaw, sell your old bonds for a profit. But if your goal is to generate steady, reliable cash flow to live on, it is an incredibly challenging environment. You're basically locked into a cycle of lower and lower returns.
You know, this highlights the two different investor mindsets perfectly. Just think about real estate for a second. One investor might buy a house to flip it for a quick profit. That's price appreciation.
Another investor buys a property to collect rent checks month after month for years. That's a cash flow mindset. It's a long-term play.
So we end right where we started, but with a much clearer picture. The question isn't just, are bonds a good investment? The real question you have to ask yourself is, what kind of investor am I? In a world of falling rates, are you playing for that one-time profit from the seesaw effect, or are you trying to build a reliable stream of long-term income? Because knowing your answer, well, that changes everything.